Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special report on the credit crunch and what it means for us here in New Zealand. It's worth taking a breath and stepping back and working out what has actually happened over the last year or so. Well, in July last year, Bear Stearns, a big US investment bank, told everyone that it was starting to see defaults on its mortgages rising. And this really freaked everyone out because they realised they'd pumped so much money into the US housing market. House prices started to fall, and banks started revaluing those mortgages, or the securities behind those mortgages, on their balance sheets. When they did that, they had to raise money from investors. Firstly, they went out and raised money from sovereign wealth funds, and that, everyone thought, was the end of that. Well, it turns out, of course, the US housing market has continued to slump, and prices have fallen, and this created a spiral of revaluations, fresh capital injections, falls in share prices, credit rating downgrades, and eventually, in the form of some, collapses for major banks. What has happened over this period to New Zealand fixed interest rates? Well, they've risen by almost 1% from the middle of last year to about March this year, and they hit a peak of 9.5% in March, so it did filter through to us. Then in March, Bear Stearns collapsed. The Fed was forced to guarantee over $30 billion worth of loans because it thought it was too big to fail. People thought, phew, it's all over. Well, it wasn't. Fannie Mae and Freddie the huge mortgage companies, they almost failed, and the Fed again was forced to bail them out. They took control of those two mortgage giants and wiped out the value of the shares in those companies. But of course, it wasn't over then. Lehman Brothers, but this was interesting. The US government decided not to bail them out. It decided it wasn't too big to fail, and this shocked everyone on Wall Street. They all had thought until then it was a one-way bet. Whenever things got into trouble, the Fed was going to bail you out. And that lasted for all of 2 or 3 days until American International Group, the world's biggest insurer, was close to collapse. Its credit rating was downgraded 3 notches, and within a day it was due to be made bankrupt. The US Treasury in the last 12 hours or so and the US Federal Reserve have decided to rescue American International Group, that the effects of the collapse of this company would have been catastrophic. So yet again they've bailed out the banks and the financial system out of the US. So what does this all mean for New Zealanders? Does this mean that the credit crunch is over and that those higher interest rates will start to drop off? Does this mean that the economy can breathe a sigh of relief and we can get back on our merry way? Well, I don't think so. I don't think the credit crunch is over yet. We've had about $500 billion worth of losses declared by the world's banks. Many people say they need to declare around $1.2 to $1.5 trillion. So by those indications, we're only halfway through it. And remember too, every time they declare a loss, they have to raise capital on the other side of their balance sheet to make sure their capital ratios are strong enough. Now, already they've gone to the sovereign wealth funds in the Middle East and in Asia, and they've got the first round of money easy. The second round of money is not proving easy, and this is why we've seen the collapses of Lehman Brothers and AIG. There will be more. There are about 100 banks listed as problem banks by the US federal authorities, and of course, the shocks of the last few days have really roiled markets and caused many share prices of banks to fall, including Halifax Bank of Scotland in the UK. Its share price fell 20%. It's the biggest mortgage bank in the UK, and actually one of its operations does a lot of lending in New Zealand, BOS International. But firstly, what do we think is going to happen to interest rates, in particular fixed mortgage rates here in New Zealand? It's worth looking at a chart here which shows that between the middle of last year and about March this year, interest rates rose by around about 85 basis points, and they hit a peak of 9.65% in March. And this is because of the credit crunch in part. And what does that mean? Well, if you've got a $200,000 mortgage, that probably increased your weekly interest costs by around $30 a week. But since then, of course, we've had the official cash rate cuts, and that fixed mortgage rate has dropped down again to about 83 basis points to about 8.8%. What does that mean? Well, if the official cash rate had been cut normally and we hadn't had the credit crunch, you would have seen lower interest rates. So the net effect of all of this is that instead of an interest rate fall, interest rates have been basically stable. And that's what we could see over the next few months. That even as the credit crunch continues to roil markets, the Reserve Bank will be cutting interest rates, widely expected on October the 23rd to cut interest rates by another 50 basis points. That's the official cash rate. The trouble is the banks may not be able to pass much of that on. So the net effect of all of this is that without the credit crunch, interest rates would have fallen much further. Given the sort of volatility we've seen in the last couple of days, where the spreads, which is the measure of the funding costs on international markets, have risen by about 80 basis points, you'd have to say that net, New Zealanders, it's going to cost around about $30 to $50 a week extra in interest costs that they would otherwise not have had to pay. Now, the separate question is, what is this going to do to our economy? We've heard Alan Greenspan say that this is the worst financial crisis in this century, even worse than the Depression, and he was around for the Depression. Is that really the case? Does that mean we're going to have a depression? Well, I don't think so. There's a couple of reasons for that. Our economy and the rest of the world's economy is much more sophisticated. Its banking system is more sophisticated. We have much more intertwined trading systems. We have a part of the world which simply wasn't growing at that time. Asia and parts of Latin America and even Africa are starting to pick up. So we're not reliant on the engine rooms of Europe and the States to the same extent we were in 1929. We've also got flexible exchange rates, and that will play a part in making sure that we get through this with some disruption, but not the sort of wholesale unemployment and mass disruption that we saw in the 1930s. But asset prices will fall, and in particular housing prices. Now, we've forecast a fall of 30% over the 2 years from the end of 2007 to the end of 2009. We're still on track for that, we think. Asset prices in terms of share markets will continue to fall. The net result then for New Zealand from the credit crunch is stable interest rates when perhaps they should have been falling. The net impact, maybe $30 to $50 a week for those people with a $200,000 mortgage, and a longer recession rather than a depression. So the recession started for us in the March quarter. It's in theory going to end in the September quarter. I have my doubts there. I think we could be seeing a recession that goes through to the end of this year and early into next year, but not the sort of wholesale catastrophic collapse in the economy that we saw during the 1930s. I'm Bernard Hickey. That was a rather long special report on the credit crunch and what it means for New Zealand.